This is part one of a special podcast with guest Robert Hogue. This is the main presentation. To hear the questions and answer session, listen to part two. Welcome to the REITE Club's podcast, Real Estate Investing in Canada. I'm Laurel Simmons, and you're listening to a special interview with Robert Hogue. Robert is a member of the Macroeconomic and Regional Analysis Group with RBC Economics. He is responsible for providing analysis and forecasts for the Canadian housing market and for provincial economies. His publications include Housing Trends and Affordability, Provincial Outlook, and Provincial Budget Commentaries. In his functions, he's frequently called to comment on the economy, both internally within RBC and externally with clients and the media. I could have talked with Robert for hours. He shares so much incredible information. I hope you enjoy listening to this interview as much as I did participating in it. So to see the charts Robert presented, go on over to our website, thereiteclub.com. Sign in, it's free, and you can watch Robert's interview. And while you're there, poke around. We've updated the website and we have wonderful things for you to discover. So now, let's go to the interview. Hi, everyone. I am really pleased to introduce Robert Hogue, Senior Economist with RBC. Robert was going to be speaking at our event tomorrow night, because I'm recording it the day before our event that you're watching this at now, but because of the provincial budget, he was unavailable, but he has kindly offered, and we took him off on that offer. He's kindly offered to give us a presentation now, and we've got lots of questions. We've sent some questions on to Robert that came in from you, the members of our community, so thank you very much for doing that. And Robert, really looking forward to this. This is going to be fun. I know you've got some great information to share for us, so I'm going to hand it over to you.
Well, thanks, Laurel. It's lots of questions. I would have had lots of questions to ask you as well, because these days there's a lot going on in the real estate space, a lot of questions, a lot of I would argue worries. I forget how many times I've been asked, are we going to see governments step in and start cooling the housing market? And it definitely is an option, and increasingly we think that's an option that governments should take on. So we are a very, very I would say maybe weird junction. Who would have thought just 10 months ago that we would be now still in the pandemic, still with high unemployment across Canada, talking about an overheated housing market, and let's call it a housing bubble, and not just in Toronto or Vancouver. It just we're seeing signs of overheating in many parts across the country. So I just want to walk you, before we go into the Q&A, walk you through a little bit of our thinking on the market, the economic kind of landscape that has led to this, to where we are today, and a little bit as well on our thinking where things are going for the housing market in particular. And I can broaden maybe in a Q&A, talk a bit more in the other parts of the real estate space, because as you know, there's there's a lot of contrast depending on which part of commercial real estate, for example, what we're talking about here. So let me just start in my PowerPoint here, because I just want to illustrate my talk here with some slides, so that I could move it. There we go. Right now, I would say over the last, I would say several weeks, we've become a lot more optimistic about the economic prospect, about the outlook for Canada's economy, and pretty much right across the board here from coast to coast. And then the main Reason has been, one, economic growth has been a little stronger than we expected in the late stages of 2020 and early stages of 2021. But also in the great progress we've seen in handling the second wave, and also those mass vaccination campaigns now getting underway. So we've just upped our economic outlook. Now we think that Canada's economic growth will exceed 6% this year, which at face value looks super strong, but really it's much more of a reflection of where we were a year ago in 2020, how deep the hole was last year. So it's a rebound. And in fact, for many parts of the country, we're talking a full recovery only by the late stages of this year at best, and in many cases in 2022. So really to put that in context, but really as it stands right now, it is a race of vaccinations and also the spread of new variants that could throw us a curveball here, and if we're thinking in terms of risk. But so far, our base case is that vaccination is going to win the day. A third wave will be contained, but then again, I'm only an economist here. I'm not an expert in public health, a public health expert here. So, but this is going to maintain the recovery we've seen so far, because keep in mind that this recession, as brutal as it was concentrated really in a couple months last year, and March and April, and by late stages of May, we're starting to see the economy start to reopen to a certain extent, and we've seen employment start to pick up. So we've been sort of in the recovery mode since last summer, where there was a little bit of turbulence late last year, early this year because of the second wave. We have we've experienced some further lockdown measures, and in case of Quebec, for example, also a curfew being imposed. But as now that the second wave seems to be under control, and hopefully the third wave remaining under control, we expect this recovery to continue. And why did we see this fairly significant rebound from last spring? One, of course, when the economy reopened, it allowed economic activity in certain sectors to pick up again. But also, it's the fact that as brutal as the economic shock was, the policy response has been as extraordinary. And here I'm not talking about a few billion here or there. I'm talking here in Canada of hundreds of billions of dollars worth of support that's been provided from all levels of government, but particularly the federal government, that really moved the needle. And if you want to put it in the terms of the economy, in terms of GDP, like really moved the needle here. So exceptional policy support. And in fact, in hindsight, when you look at what the kind of transfers that were provided to household, they've been quite generous. I mean, I don't want to minimize here the hardship that many Canadians have felt through the pandemic and continuing as of today, but in aggregate, the support, the financial support that was provided turned out to be quite generous, and even in some cases, the CERB, for example, made some people even better off than they were pre-pandemic. So very, very strong support coming from government. Also, so when you think of the economy, there's two main policy levers here. There's a fiscal policy, which I just talked about, but there's also the monetary policy that is under the control of the Bank of Canada, and clearly the Bank of Canada from the get-go did all it could to set the stage for recovery. Of course, monetary policy won't be able to stop COVID from happening, but what it did, though, is that it kind of set the stage for once the economy reopens, that it would provide all the oil needed to get the engine running again. So that what the Bank of Canada has done is that, well, on many fronts, but one of the main things that it has done is cut interest rates effectively to, well, in my book, to zero. It cut its policy rate, the overnight rate, to 1/4%. And not only that, it has pledged to keep it this low until, based on the last statements from the Bank of Canada, for a long time, until the early stages of 2023. Now, Bank of Canada might well change its mind between now and then, and in fact, we expect the Bank of Canada to start raise interest rate by the second half of next year. But nonetheless, I think the point is very low interest rate for a long period of time. And especially at the short end of the yield curve, so the short-term interest rate. Longer-term interest rate, we've in fact actually already seen a little bit of a pickup in recent weeks. Our view is that longer-term interest rates, long-term bond yields are going to continue to creep a little bit higher. We don't expect any spike on that front. So it should be manageable for the economy and the housing market more specifically. So very strong policy response, fiscal policy, monetary policy, going all out. And what this has done is that it's contributed, and quite surprisingly, has contributed to a spike in household savings. So those financial support ended up at the time when many Canadians were not able, and still to this day not able, to spend it as freely as what they would do normally. Think of, all the sectors are still closed: restaurants, the hospitality, airlines, all the travel has been effectively stopped or greatly reduced. So what Canadians have done is that they've built up their saving quite dramatically. We've seen the savings rate reach by far a record high in the second quarter of last year, but they've continued to savings continue to be very, very high since then, even though they've come down slightly. So strong buildup of savings that really was also a factor to get the economy going, and the housing market in particular. And the fact has been that the COVID-19 recession has been incredibly uneven. It's been uneven on so many layers, from a regional aspect, from an industrial aspect, but also from an income distribution aspect. It's been mostly Canadians at the lower end of the income scale have been most affected initially, and I've seen the slowest recovery since last summer. Whereas those at the higher end of the income scale, the initial shock was not quite as brutal, and by now the employment level is back to pre-COVID levels. So if you think in terms of the impact on residential real estate, it really, in terms of home ownership, it really is about those at the higher end of the income scale. Those have not been quite as affected. They've benefited from exceptionally low interest rate, plus they've built up quite a bit of savings. So it really kind of lined up all the stars to get the housing market going. And those at the lower end of the income scale, they're more likely to be the renters. And we've seen that the rental market, especially in the large urban areas in Toronto, Montreal, Vancouver to a certain extent, going through a rough patch. We've seen the vacancy rates rise. And there, demand has been part of the issue, but there's also been a big issue about the supply side. We've seen a lot of rental supply come online. A lot of this, and when I mean rental supply, is more on the longer term rentals, and a number of those units were previously in the short term rentals, and COVID has been quite a bit of damaging for that business, the Airbnb business. as well as in areas like Toronto. There's been some stricter regulation that kicked in last fall that pushed many short-term rental operators putting their units into the longer-term rental. So all this to say that the COVID, at the end of the day, if you think of the housing market as stimulated and heated up the ownership market very, very dramatically, but at the same time, it cools some of the rental markets for a period of time. And this, in addition to the factors affecting rental, in addition to a slower immigration that we've seen. And I'll come back to this in a few moments. So I've been building this up here, but ultimately, we're getting the results that in hindsight should not be that surprising. The housing market has boomed since last summer. Here I'm showing Ontario as to illustrate what I'm saying, but it is true pretty much across the board in Canada. Like the existing home market has surged since last summer. We thought initially it might be just a flare up in the summer because we knew that pent-up demand had built through the spring, but it was clear by the fall that there was more than just pent-up demand here. It was fundamentally very, very strong demand, and the real the very interesting part here, the point here, is that this is not just a big city phenomenon here. This is not just Toronto or Vancouver or Montreal. This is, large parts of the country, smaller markets as well. Here I'm showing the kind of activity increases that we've seen across smaller markets in Ontario. You can, I can come up with something similar for many parts of Quebec and also parts of BC as well. So clearly this is beyond just a big city development here. The very strong demand exacerbated an issue pre-pandemic where supply was pretty low to begin with. And in fact, early in 2020, my main message to many people in the sector was, look, things are heating up. There's just not enough supply. This can only point to prices rising, not only rising, but rising faster. And indeed, through this pandemic, supply has come down even more. So when you compare to, say, a longer-term average, supply levels, so the inventories are exceptionally low in many parts of Canada, including Ontario and Quebec, and BC as well, and parts of Atlantic Canada. Very low inventories, obviously. When you have strong demand, low inventories, this is a recipe for prices to spike. Clearly, sellers are in the driver's seats right now, pretty much across the country, even in markets that were struggling prior to the pandemic, like in Alberta, for example, and in other parts of the prairies. Now it's pretty much a seller's market all around. Pressures are more intense in central Canada, parts of eastern Canada, BC, but nonetheless pressures are building pretty much across the board. So what we're seeing now is that prices are not only didn't skip a beat during really and overall through the pandemic, but they're now they've accelerated. The main exception is on the condo side. I would say downtown condo segments, and it's largely a reflection of the rental market, because, as you know, there's a big chunk of the condo stock goes towards or serves the rental business or a sector. So that's maybe the only, up until very recently at least, the only exception. Now we're seeing interest in the downtown condo segments having risen quite significantly since maybe about December, somewhere around there. In other words, ever since vaccination has begun in Canada, and price pressures reflecting what has been in terms of activity has been quite widespread. This is, again, this is not just a core Toronto or Vancouver or Montreal. This is this has a much larger base. And in fact, it's the smaller markets, if you think of Barrie, Ontario, for example, or Tillsonburg, or Mont-Tremblant in Quebec, for example, or the smaller places like Mission, BC. This is where the price increases have been the strongest so far. So and this is quite unusual, and in fact, to see so much how synchronized markets are at this point. Typically, housing markets are a little bit of islands on their own. You can have Toronto overheating, but issues in Montreal or Ottawa and elsewhere. But at this point, it is a very highly synchronized swing in the market. Now, the big, and this heating up of market is taking place despite immigration having plummeted through the pandemic. And as I've mentioned earlier, this is not to say that the drop in immigration had no effect on housing at large. It's just that it has, at least not yet, negatively impacted the ownership market. On the rental side, for sure, we believe that the drop in immigration contributed to the soft patch that we've experienced in some of the rental markets in Canada. But if immigration were to remain this low for an extended period of time, eventually, at least in my guess, we would see some kind of negative implications on the ownership side of things. So we need to continue to keep an eye on. The federal government has been quite adamant to make up for any losses in terms of number of immigrants coming into, or permanent residents, I should say, coming into Canada. The plan is to get more than 1.2 million people, new permanent residents in Canada this year and over the next two. We are very skeptical of the ability of the Canadian government to hit the target for this year, but certainly over the next couple of years, assuming the pandemic comes under control, we'll be able to reopen our borders, and then the immigration wheel will start turning, not only normally, but because Canada's increased its immigration targets for this year and the next two, the odds are immigration is going to be even hotter than we had pre-pandemic. So that's something to keep in mind going forward. It is both it is an element of risk both on the upside and on the downside, depending on how quickly immigration is going to pick up. So I'm going to leave it at there. Oh, and yeah, I think I'm going to skip those. I mean, immigration tends to go to the large urban areas. So obviously, this immigration story is much more of a story for Toronto, Montreal, and the Vancouver or Lower Mainland in BC. Whereas and the movement of people within the same province tends to be more of an impact or an effect on some of those smaller markets in the periphery of the larger market. So I think I'm going to leave it here, just to be mindful of leaving enough time for Q&A. Just quickly, a little bit of a sales pitch here. I mean, we've got a distribution list for our report. We constantly report not just on housing, but anything about the economy. So I invite everyone to sign up for our distribution list, and because I'm convinced those analyses and commentaries that we put out will be of a great value to you. So on this, I'm going to turn it back over to you, Laurel.
Okay, thank you. So those distribution lists, I can see the URLs up there on your screen, www.rbc.com/economics, and then https thoughtleadership.rbc.com. Is that where people can go to get those reports, or are they somewhere
and you'll
else?
see, no, this is, you can go on those, that site, and then you'll have the opportunity to click on join distribution
Okay.
distribution list, and then you'll just need to provide your email address.
I hope you've enjoyed this special podcast with guest Robert Hogue. We really appreciate it if you'd rate our podcast, because it does help us to reach other people who are interested in real estate investing. Thank you for listening. And as always, I want to remind you to come grow with us. Bye for now.